Welcome to the Techno Fundamental Report for November the 14th. The siren song typically refers to the song of the siren. Greek mythology. You know, the market is designed to fool most of the people most of the time. If it's not doing that, then it's not a market. So the fear of missing out, called FOMO. Be just aware of the fact that we've gotten a major rally here. Things look very good. However, be careful about extended issues where, like the siren song, it's pulling you into the rock. So just be aware of the fact that things are kind of frothy here, but look for solid bases, solid setups, and you should be fine. You know, on the presidential election, I'm asked the question many times, how important is the election? And I really have to say it's really not that important. It's important, but it's on a list of important things. Number one would be corporate earnings. Number two would be interest rates and inflation. And then number three could be who's president of the United States. Now, I went back to 1995 when Bill Clinton was president, because a lot of times I'll just think about this. People will say to me, especially a friend of mine who's just a big Clinton fan, is that the stock market did really well during this period. Realize, you know, the NASDAQ went from 800 to 4,100 in this period of time. Now, actually, this period here and this period here were quite phenomenal. It wasn't Bill Clinton. It was because the internet was invented. You know, Cisco Systems, America Online, Yahoo, all those things. So just remember that it's corporate earnings first, and the rest is less than that. So, you know, chasing the market can be a difficult decision or a mistake, but, you know, we are in a power trend, and we'll talk more about that, but things do look promising. Now, the thing that's interesting here about the presidential cycle is that November and December tend to be the strongest months, according to history, after a presidential election. So what we're really saying is that we really need to deal with the issue of our federal debt. It's got to be dealt with. Elon Musk has been brought on board to run a agency or a division of the government that will work on reducing government spending by eliminating some of the federal workforce. The reports I see is that we need to at least eliminate 25 to 50% of the federal workforce. We've got to bring our expenses down. Now, what's unfortunate about all this stuff is that government consumption as a percent of GDP over the last several years has really gotten out of hand. In fact, this report says further the recent GDP number of 2.8% is tainted because 85% of the growth was due to government spending, not productivity. The government is not productive. It doesn't really add to productivity. In reality, only 15% of the 2.8%, or 0.4% was true growth, the U.S. government that exists in the U.S. economy today. So this has got to be cleaned up. I don't know if y'all remember, here in Louisiana we had Buddy Roemer, and he had a slogan, slay the dragon, scrub the budget. I think what we should require is that anybody working in government has to take an accounting course, because they just don't seem to know how to balance a checkbook. I mean, it's ridiculous. And so Musk, when he came into Twitter, he was able to cut their staff by 80%. So he knows how to do it. So there are 438 agencies, and sometimes they don't even know the exact number. There's so many of them. But they've been, since the beginning of our country, they've been adding one agency per year. So it's just got to be reversed. Now, our strategy is to try to find the elephants. We want to find the Apples, the Cisco Systems, the Amazons, the Walmarts. You know, back in the 70s, and this is one of my biggest fears about the economy and why we got to get our spending under control. Back in the 70s, the Fed would raise interest rates and they would cool inflation down, and then inflation would just come roaring back. So the experience of the 70s was quite difficult. The market peaked in 1966 and then dropped at 1,000. It peaked at 1,000, then dropped to 574. And it was just an incredibly difficult period. So when I went through it, and then around 1982, I looked back on it, I said, what would have been the solution to this? You had to buy Walmart. It was the bottom line. Walmart was the leadership of the market, and that's where the money was being made. You know, also McDonald's and Home Depot and all those different things. So it's, you know, you could say, well, we could just throw darts at newspapers to pick stocks, but I think it's a little bit more complicated than that. Now, I want to remind everybody that we are in a bull market, and this bull market is being driven by demographics, just like the bull market of 1982. There's the baby boomers that came along. And so if y'all remember, you know, Alan Greenspan was talking about our irrational exuberance. This could be a long-term process where we don't see the millennials reaching age 54 till 2035. And that's where the baby boomers were here. So we've probably got 10 more years of favorable demographics. Now remember, our economy runs on consumption. And so the baby boomers and young people tend to consume more, and so you got to keep your population young. And we're probably the only country in the world that has this benefit. Ed Yardeni, he lifts his target on the S&P. He says Donald Trump's win in the Republican sweep is consistent with the roaring 2020 scenario. So he agrees that we've got a long-term bull market here. And he basically says that we could continue to rally into the 2030s, which matches up with our demographic study, which is 2035. So get comfortable. We're in a bull market. Don't fight the Fed. Accentuate the positives. Eliminate the negatives. The trend is your friend. Don't fight the tape. It's time to step up. Now realize what we're dealing with here on the federal debt is a turnaround story. If Musk and Vivek Ramaswamy can get in there, get the expenses down. Now, realize the largest outlays by the government are mandatory distributions, which is Social Security and Medicare. They're probably going to have to address that issue at some time. All right, so we are in a power trend. As you can see, and the rule is basically, without going into details on it, it's where we're using moving averages to determine the strength of the trend. And so right now, under our circumstances, which is the power trend, which was developed by Mike Webster over at Investors Business Daily, the NASDAQ continues to be in a power trend, so we're in a positive mode there. S&P, same thing. We are in a power trend. Now remember, the power trend will end if the 21-day crosses below the 50. So the market continues, the trend is healthy, and it's strong, so that's a positive. Now interest rates have been kind of creeping up. This is our power index, which is we want to stay below zero. So you can kind of see here, for the last 165 days, interest rates have been climbing. So hopefully inflation doesn't come roaring back, because that means higher interest rates. The primary trend continues to stay up. This is probably one of the best indicators to use for long-term analysis. This is the 200-day moving average. It's a very simple indication. So the trend is up on the S&P and the NASDAQ. So like I say, we're in a healthy situation. This is the VIX, the volatility index. Tremendous drop here since the election. That's a very positive sign. The VIX basically is a fear index, and it's saying right now that there's just not a lot of fear, which is troubling in a way. Crude oil continues to come down. You can see it's definitely on the trend meter. It's definitely in a downtrend. The price of oil is now below $70 a barrel. Now remember, Trump's theme is on energy is drill baby drill. So if they start drilling again and raising the reserves, there's already too much oil out there now. So I think the market's discounting additional supply coming on the market. Value line geometric has clearly broken out. Now this index is very important to my strategy, because this is mainly growth stocks, and we deal in growth stocks. But you can kind of see here that we made that final low here back in November of last year, and then we've rallied, got to the top here. Now this is what we call resistance. So the value line geometric has broken through resistance, so this now probably becomes support. you've got basically what it's saying is that investors are comfortable with this pricing. So the value line geometric is definitely breaking out, looking like it's going to trend. The aggression index, again, let's remember here, this is the NASDAQ composite divided by consumer staples, which means toilet paper, basic goods. Well, when the indicator goes up, that's a very big positive. We've now got a golden cross here on the moving averages. So the aggression index is basically saying you need to be aggressive here. It's time to step up. Anyway, gold, you can see here what's going on with gold. It's basically coming down pretty steadily, which is, again, another way to confirm the VIX, because gold is actually a fear asset. So good news, bull market. Thank you very much. If you have any questions, let me know.